The second quarter of this year has paralleled the overall economy except the stock market lately. It has not been exceptional, but it has not lost ground. It continues to move ahead slowly, and the commercial real estate bubble that many people are waiting to burst as 5-year terms come due does not seem like it will hit South Central Pennsylvania hard. It may be more a figment of our imagination for South Central Pennsylvania. If you remember during the S&L crisis in the 90s, we had less than a handful of S&Ls that had problems. The majority that had those issues were not in the area. The same could be very true for the potential looming crisis that our country now faces with commercial real estate mortgages. However, a lot has happened now that is much different in our economy, which was not present during the S&L crisis. I'm not sure anybody can accurately predict what is going to happen within these next 12 to 24 months. However, let's take a look back now at the last 90 days. The office lease market continues to gain momentum. Most of it is in the B segment, with the rates currently between $13.50 to $16 a square foot. This is all inclusive except in-suite janitorial in most cases. 3 to 5 months of free net rent for office leasing is still being offered on 3 to 10-year deals, with the free rent months typically being added to the end of the lease, so income for a full term is still being received by the landlord. Other than that concession and lower rental rates overall, there are really no other concessions being given at this time. The office sale market has stayed the same as the first quarter. Smaller buildings, 7,000 square feet or less, are holding their value as long as they're well located. That value is somewhere between $100 to $115 a square foot for A buildings and $85 to $100 per square foot for B buildings. Moving into the third quarter, I don't think the prices per square foot will significantly escalate. However, I do expect the volume of sales of these buildings to increase. And if these buildings cannot be found, which is currently the case, the 7,000 square feet will increase to 10,000 square feet as the favorite size, as it was prior to 2008. At this point, no new construction is coming out of the ground. There are a few projects that are permitted and ready to go, but nobody is taking that chance until they have secured a tenant. In the warehouse market above 100,000 square feet, there is still a lack of activity. This is very similar to the way it was in the first quarter, as the warehouse owners, who can afford to do so, offered some extremely huge discounts for the next 3 years, as they anticipate the market will be better after that time. Within the next 3 years, warehouse users could do $2 to $3 triple net deals. After that, landlords were banking that the market would be back, so any options granted were at fair market value. However, we do have more occupancy today than we had 12 months ago. Currently, the rates on A space are in the $2.75 to $3 per square foot range on a triple net basis. With these aggressive prices, the B space deals have been minimal, as people will pay these former B rates to occupy A space. The B buildings are ranging from $1.95 to $2.75 a square foot triple net. Currently, the overall vacancy is about 12%, and as net absorption continues to increase, the vacancy rate should drop by the end of the third quarter. The flex market has stayed pretty much status quo since the last 90 days. There are still some deals floating around, but no more or no less than what was there during the first quarter of this year. The average size of these deals in the market are smaller by nature, 5,000 to 10,000 square feet, with maybe 20 to 30% office in many cases. Vacancy in the flex market can run anywhere from 10 to 15%, or higher in the case of new construction that is still in shell condition. The rates for new construction with 20 to 30% office space can be somewhere in the $10 per square foot range on a triple net basis, and for second generation space in the $6 per square foot range, again on a triple net basis. Although that market has been slow, there are signs that it is not retreating, rather it is staying steady and perhaps moving forward with small increases similar to those we saw in the first quarter. The land market is still very sluggish as it was during the first quarter. People are not buying at great speed because of the time it takes to get the project done, with no income stream and the amount of capital needed to make the project happen. With the unknown factor of financing, which was true in the first quarter, we continue to have the same situation of people not knowing whether or not the project can get financing. Although there will continue to be small land sales in different places, It will be close to a year before we start to see a return to the levels similar to what we saw prior to 2008. During the second quarter, the retail market showed signs of improvement. Small spaces in neighborhood centers started moving their rates north as high as $18 a square foot triple net. The spaces in the anchored centers were between $16 to $20 a square foot, again triple net. With this new strength, the landlord's desire to do tenant improvement work for the tenant as part of the deal started to fade away. There is much less of that at this time. The vacancy rate right now overall for retail in this market is 8 to 10%. There is no doubt that retail is slowly picking up. Outparcels have maintained the same reduction in price as they did in the first quarter for those people looking to buy or lease pad sites at retail centers or in general. As concessions are being made, this is fueling some of the growth for the businesses that thrive at these locations. C-stores and banks were used to paying much larger numbers for the same land 3 to 4 years ago. The lower land prices, in addition to concessions, are making these sites much more economically viable and in demand. Overall, the market has not changed much since the last 90 days, but the good news is it has not retreated regardless of the economic factors you are following and may be trying to compare to the real estate market. Retail and office leasing and sales have made some gains. The other markets have made very modest gains or stayed neutral. It is not a strong market, but it's a steady market. It is a riskier market than in previous times, but no riskier than the first quarter of this year. Opportunities abound for those who have higher levels of risk tolerance. Although this last 90 days has not pushed us forward, we have not retreated. And now we are looking forward to the next 90 days.